Welcome to another edition of Money Matters. My name is Dan White. I am the host of the show. I'm also president and CEO of Daniel A. White and Associates, a retirement planning firm. We have our headquarters in Glen Mills, Pennsylvania. We have two satellite offices, one in Middletown, Delaware, and one a little further south down in Lewis, Delaware. And we work primarily with people in the pre-retirement and retirement stages of their life to make sure they have the income they want. They have an inflation hedge. They have growth. They got their Medicare supplements in place. Just basically everything soup to nuts from a retirement planning standpoint. And one of the questions I always get every day or every week is, what is going on with the markets? And I got to tell you honestly, this is one of the most confused times I've been about the stock market in a long time. I mean, stocks ought to be down more, right? We're at war. I'm pretty good with technicals, but the stock market has really been behaving in a very unexpected way. And one of the things I heard a long time ago is markets can remain irrational longer than you can remain solvent, which is kind of funny. I mean, we're literally 30 points off an all-time high. And we're just vacillating. I mean, we were down about 9% off the high. And then we've had this relief rally. I mean, on the one hand, 1 week, Donald Trump is going to blow Iran to smithereens. And then 2 weeks later, we got a ceasefire. And again, and then they're violating the ceasefire. The bullish move doesn't make a lot of sense from a macro standpoint. But here we are. I mean, stocks are basically in the same place they were just a couple months ago, but now oil is $40 higher, which is crazy because usually when you get these, when you get an inflation bump like this, I mean, the market doesn't react in a good way. The other thing that's going on, we just had a report out, the U.S. Consumer Sentiment Index from the University of Michigan with data going back to 1952 has never been lower than it is today. It fell to 47.6 from 53.3 in March, and Americans expect inflation to rise at a clip of about 4.8% over the next year. And this sentiment reading is lower than the tariffs last spring and the inflation spike in the summer of 2022. Not even March of 2020 during COVID or the Great Recession in 2008 saw consumer sentiment levels as low as they are right now. And adding to this is inflation. We're going to see higher inflation. So it's amazing to me that the market is touching on all-time highs. It's really baffling to me. How bad is it out there for the everyday consumer? Bloomberg came out with this article, pawn shop loans spike as high gas prices weigh on Americans. So people are going to pawn shops for loans. So economically, we're not in a good spot, but for some reason, the markets continue to go up. And I think oil prices are going to go up a lot more. But again, I'm kind of at a loss here as what is driving this market. So I wish I had better news on that. I'm fortunate today, though. I have a co-host, Doug Bloom, the founder of DAB Ventures, is on the program with us today. Welcome to the show, Doug.
Hey there, how you doing, Dan? Thank you for having me on the show.
Yeah, you had a pretty interesting day, and you were running a little late, but we got you on here, so that's all good. But let me ask you, Doug, what are your clients talking about today? I just gave a little overview on the markets. What are you hearing on the street?
Well, I think there's two major themes that I hear. I work with small business, small to medium-sized business owners and operators, and the advisors that support them, accountants, lawyers, sometimes wealth managers like yourself, Dan. But the people are talking about two major themes. What should I do about AI? And you hear everything about open claw and agents and everything running everything, and people feeling behind. FOMO is very big. And the other is what you just alluded to. When is the economy going to catch up with all the bad news? And your point about what's driving this market, I don't think anybody's at the wheel. I think it's Keystone Cops. When you think about where some of the long-term ratios are, when you think about where some of the fundamentals of oil prices and transportation costs, The economy is going to get hits pretty soon. I think jobs are off, and sentiment's off, and GDP's debt's rising and GDP's not rising. So that's a bad combination.
Yeah, it's really kind of scary, you know. And when you bring up AI, you know, on the one hand, AI is for the last 2 years has pretty much driven the market, the big tech companies, but at the same time, it's eliminating a lot of jobs, you know. So careful what you wish for. Yeah, it's driving the market, but it's also creating a lot of job losses, and you just wonder when that's going to filter into the economy at large.
Well, I think you look at automation in any form as a transformational event, and technology such as the car, the automobile, made for a lot of jobs, made for a lot of opportunities for improvement in everyone's life, efficiencies and opportunities. But if you're a horse, the introduction of the automobile is not a good thing. So I think the real point is that you're not going to lose your job to AI. You're going to lose the job to somebody who knows how to use AI as a power for themselves and for their companies. And I think that's the piece. So education is big, and just opportunity to explore and learn how to use it.
You know, continuing along that track, I was just out at a conference in Las Vegas, and it was really weird. I must have seen about 5 taxis that were self-driving, you know, the Waymos. And, you know, when you see a car going down the street with no driver, it kind of freaks you out a little, you know, and that's kind of what we're seeing. And that's going to eliminate some jobs right there. I mean, if they don't have accidents, I mean, you're talking body shops, you're talking repairs, you know, all this kind of stuff that could be eliminated by some of these technological advances.
Yeah, I think they'd make them more aesthetically appealing if they had the blow-up doll from an airplane in the pilot seat. I mean, that would make it a little bit more appealing. Yeah, to see a car drive down the street with nobody at the wheel. Yeah, what you're looking there is you're looking at a metaphor for the markets. We're right back.
Yeah, exactly right. So, what has held your fascination lately, Doug? When you talk about AI and all, what are you hearing?
I'm gonna parrot one thing is AI. I'm looking at how do I develop and employ an open claw agent to do the work that I don't want to do. And I've had a lot of conversation and some study and exploration in that vein. So look out, maybe next month I'll have something up and running. It'll probably just tell me that I'm awake. And I think the second thing that's really captured my fascination is some research I've been doing into what are the patterns of small to medium-sized businesses and the senior teams of those companies that identify organizational speed as a function of decision-making speed. Now, how quickly and how well do organizations make aligned decisions so everyone walks out of the room with the same agenda and they know where they stand and they know what has to happen. I just had a conversation with a client today, and my parting words to them was, hey, you guys have decided X, Y, Z. You've got to make that a reality. You've been struggling with making this decision for months, if not for a much longer time. And you need to move with the decision and make it real versus having it come up for grabs again.
Yeah, the other crazy part I read recently was the top 4 companies in the AI space. You know, you're talking Google, Amazon, Microsoft, and maybe Facebook. I mean, they're projected to spend like $700 billion on this, building out this AI infrastructure. You know, you just wonder how much money are they going to spend before they see any return on investment.
Well, you also raise another issue when you talk about those companies and the way they're financing with private credit, and sometimes they're borrowing money from one organization to spend with another organization. So it looks a lot like a Ponzi scheme in some ways. So somebody's going to unravel that. They're going to pull on the string, and the whole thing might unravel. It might catch a knot, but if it is less structured with checks and balances than anyone can imagine, it could be pretty ugly, much like the credit unraveling in 2008, 2009.
Yeah, and you just wonder if the AI bubble isn't going to go the way of the .com bubble from 26 years ago. So we do have a question from one of our listeners, Grace Danmore from Philadelphia. She wants to know, and this is what a lot of people want to know, how do you handle risk in today's stock market?
Well, that's a very interesting question, and I really should be tossing it up to you, but I'll take a stab at it. It's a question of where do you see risk? If you see risk in being overweighted in technology stocks, and technology investments, then you can offset into other types of equity-based investments, whether they be dividend-paying stocks, value stocks, such as Pepsi and Coke and companies like that. But you can shift your allocations from ones that you see as more risky into ones that you see as being more steady, and especially dividend stocks. You can gain on appreciation, but if you don't, you still get that current coupon. And some of these companies and funds out there, ETFs paying dividends, are doing it in the 4% range, some more, some less. I think the other way you can evaluate risk is you can say equities themselves are risky, and so you want to move your capital in part, not 100%, into commodities such as gold. I'm going to tell you oil. I agree with Dan. Oil is going to continue to go up, but you can move your money into commodities, or you can move it into treasury bills, or even just put it in cash to some chunk of change. The bottom line is you want to de-risk yourself from equities. There's a couple different ways to do it.
Yeah, people do have options. I agree with you there. I mean, like you say, sector rotation, going from growth to value, and maybe out of tech into pharmaceuticals, into commodities, that type of thing. So if any of our listeners do have a question they want answered on Money Matters, here's how to send in your questions to us.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Okay, so now we are fortunate today. We have a guest on our program. We have Bob Molony, a consulting partner with the ERA Group. They work in the expense reduction services space. Bob, welcome to the show today.
Thanks for having me, Dan. Glad to be here.
Yeah, we're thrilled to have you. And I guess to start off, can you kind of just walk us through what your process is, what type of work you do, and provide an example of what it is like to work with ERA Group for somebody that wants to reduce operating expenses?
Sure, Dan. So ERA Group is one of the largest strategic cost reduction consultancies in the world. We've got probably 1,100 consultants in 60 different countries now. And the value proposition that we provide is having expertise in a broad range of cost categories. That includes anything from insurance to factory consumables, medical equipment and supplies, even food services.
Bob, what unique value prop does ERA Group provide to their clients to enable them to recognize innovation while cost cutting versus just belt tightening?
Well, the opportunity that we provide is being able to allow clients to look at their expense profile through a different lens that gives them the opportunity to look at things that potentially they're not paying that close of attention to. Most businesses, they are very well versed in their core products and services, and the suppliers that support that, they also are very educated about. However, with the secondary cost or indirect cost that they consider the cost of doing business, they may not have as much expertise, and likely that's where the opportunities are lying.
Bob, I'm going to go off track a little bit.
Sorry, go ahead. Saying the strategic costs, most business owners had a good handle for, but the other costs, the secondary costs, are the ones where you guys find opportunity. Is that right?
Exactly.
Okay. Thank you.
All right, so Bob, I'm going to go off track a little bit. We talked a little bit before the program about, a local gentleman here who spends a lot of money on advertising, and I know our firm spends a lot of money on marketing and advertising and doing seminars and that type of thing. So, you take somebody like me that has the attitude, hey, you got to spend money to make money. How would your group look at a situation like that when most of the money you're spending may not be operational. It may be more marketing driven.
That's a great question. So the area that we really excel in is having benchmark data to be able to compare not just your business and your business spending against yourself, but other businesses in the same industry vertical well as other businesses in general, and having that breadth of insight actually enables us to be able to go to market and deliver best in class prices for our clients. Not only that, but our consultants are frequently experts in their field. A lot of them have experience in the C-suite. Some of them have advanced degrees, and in every case, they have a vested interest in delivering best in class results for clients, because we get paid on a success fee. If we don't find savings, we don't get paid. When we do find savings, we share in that savings with our clients.
So, Bob, what are the challenges you face when implementing customized cost reduction strategies for your clients?
That's a great question. Doug. I want to say the biggest challenge is a lot of times the CEO that's sitting across the table believes that they have a better way to be able to accomplish it, or they think they've got their expenses under control. Could be a situation where there's not necessarily just with the CFO, but with other stakeholders in the organization, where they have relationships with suppliers and service providers that provide them with maybe some type of value that they're not willing to sacrifice.
So Bob, just a quick question, and this does crop up for me. So how does your group ensure that when you're cutting costs, that number one, they're sustainable long term, but again, without compromising the business growth or the employee morale? Because again, I go back to, you got to spend money to make money. You got to keep your people happy. A happy employee is a productive employee. And now you're talking about cost cutting, and everybody's probably walking around on pins and needles, like, where's the axe going to drop next?
That's a great question, and I want to say that we are an advocate for employees, in that we focus only on their indirect or supplier costs, not their employee costs. We actually try to find additional cash flow to help them to create jobs. When you look at being able to build cash flow and working capital, it's important that you have the trust of your clients. We work directly with stakeholders in order to be able to find out what their needs are and make sure that when we go to market, we're delivering to them either better or equal quality to what they are currently getting, and we work with them over our engagement to ensure that they're being educated so that they can sustain the savings long term.
So, Bob, I'm going to kind of take a hop from the conversation a little bit different. Mm-hmm. How has the ERA group evolved in this current market climate with inflation and supply chain issues and clients being very, very scared? How have you guys evolved your approaches, and what is it doing? And what are the market changes doing to affect your ability to identify opportunities and serve clients?
Well, in my opinion, the market conditions that we're currently experiencing with inflation, the oil crisis that's developed out of the Iranian conflict, all of those things are actually benefits to our business, in that we can help clients to navigate and adapt to the current circumstances. They don't have to depend on their own knowledge. They're able to leverage a broad base of knowledge within our organization to be able to advance their real. I'm going to say most business leaders are not really focused on cutting costs. They're focused on growing their business. And what we do is help them to find that the incremental cash flow to help them to do that.
Again, a little bit off track here, Bob. It wasn't one of the things that you might have been planning to talk about, but tariffs. right? I mean,
Mhm.
tariffs had a huge impact on companies last year. How did some of your clients deal with the tariff situation?
Well, as a matter of fact, we were able to help them to navigate tariffs and work out arrangements where they were able to either use near shore sourcing or onshore sourcing whenever possible. Um, did, this doesn't answer the question directly, but to give you something that potentially can make sense. So most businesses, when they're looking at their freight, they've got relationships with maybe a half a dozen different carriers. And if they get caught in a pinch and they don't have someone to deliver their products, they might get stuck. Our analysts are that focus on freight potentially they've got relationships with probably 200 carriers, and they have someone they can go to in a pinch that can help a client out.
So, Bob, you and I had a conversation one time, and we were talking about how you do your work. You're hands-on. You're not just handing this off to a service bureau in South Carolina somewhere. You're actually involved with the client. What does that look like?
Well, I really like that question because to me, I'm an operations guy deep down, and I really like to dig into the data myself. I recently, I'm actually in the process of working through an opportunity assessment that we did with a client that involved taking a 12-month snapshot of their GL data, drilling down into finding the opportunities, and I'm in the process of selecting a team to put together to help them to work through a number of different categories that includes things like facilities and insurance and food services to give you an example. Sometimes it's not what's on the surface that stands out, but what's behind the scenes. And not only that, but we're part of we're not just a consultancy that provides a report and walks away. We actually are reviewing that data on a monthly basis. We're reviewing invoices, providing feedback to clients, looking for rebates, and always staying on top of the market so that they are getting what they agreed to at the onset.
So, Bob, can you share just a real quick, maybe success story from the ERA group where you implemented your strategies, you delivered a meaningful return on investment, and what made that particular partnership stand out for you?
Well, yeah, as a matter of fact, I can. So I helped a client to reduce their costs regarding printers and copiers. Engaged with one of my partners, and when we initially did the RFP, the incumbent supplier they came back with an offer of about 17% savings. Two competitors were 50 and 52% respectively. In this particular case, it went a little sideways because the client had a relationship with that supplier. And they went back to the supplier and we're asking them, well, what's going on? Why didn't you do better? So in this case, we ended up going to market again or letting them rebid. And the incumbent still did not provide a reasonable quote. The client ended up moving to one of the other bidders. They didn't take the lowest bid, but they ended up saving 60% on their printer costs over a 2-year period of time, and it represented over $100,000 to them.
It's awesome. 60% is a big number. Mm-hmm. The another kind of oddball question, but I think it'd be illuminative for our watchers, viewers. What's an ICP look like? What's an ideal client profile look like for you? You said you like open-minded CEOs. What and CFOs? What does an ideal client look like for you?
An ideal client would be a manufacturer or healthcare provider. If it's a nonprofit healthcare provider, even better. they're producing revenue between $10 to $50 million. That's probably the sweet spot. We can do more than that, sometimes less. But the opportunity lies really in how many different categories that we're able to approach. The more categories, the more savings we can provide.
So Bob, if we had a small to mid-size business owner watching the show today, what's one kind of low-hanging fruit cost-saving tactic that you guys have used that they could implement immediately and see some savings?
Well, I was hoping that you'd ask a question like that, Dan. So 70% of health insurance for businesses will renew January 1st of 2027. And most business leaders, they probably are looking at their carriers maybe June through August. But actually, now's the time. Now's the time to jump on it and get ahead of it, because there is opportunity for savings with insurance that can be discovered. It's not really it's not necessarily a broker's game if you have the background knowledge and the benchmark data to support it.
And I guess this might be our final questions. Had a pretty good conversation so far, but looking ahead, Bob, what are the trends you see in operational cost efficiency through your lens, augmented by your colleagues at ERA? And how do you prepare your clients for these upcoming trends?
Well, what I tend to use the word that we're in a period of certain uncertainty, and margins will continue to matter. So what's important is that you need to adapt to the circumstances that are in front of you. And I mean, this is definitely not a time where this is the way we've always done it is going to work. This is a time where it's all about being able to change and find ways to be able to shift your suppliers, negotiate from a position of strength to renew your contracts effectively, and don't take anything for granted.
We appreciate you being on the show today, Bob. And next week or next month, our guest is going to be Lance Morgan, the CEO for Legacy Educational. I want to thank Doug and Bob for being on the program today. And until next month, another edition of Money Matters. Have a great week.
Thank you.